Hello and welcome. Today we are joined by Umesh Kumar Mehta, Executive Director and CIO at Samco Mutual Fund. Samco Mutual Fund is launching a new large and mid cap fund with a unique momentum driven approach. But what really sets it apart in a crowded category? And how does momentum investing work in the large and mid cap space, traditionally dominated by steady performers? Over the next few minutes, Umesh Kumar Mehta will break down their innovative care momentum strategy, how they balance risk and responsiveness, and who should consider adding this fund to their portfolio. Welcome, Mr. Mehta.
Thank you.
Good to have you with us. Now, what sets the Samco Large and Mid Cap Fund apart? How does it stand out in a category that already has several established players?
So there are 31 funds currently available for the investors in the large and mid cap space. When we look at their investment style or investment strategy through SEBI SIT filing document, everyone is either quality, growth, or value. None of them runs momentum as a strategy. And this is where our fund will run momentum factor when we will identify stocks in the large and mid cap space.
Okay. And why is momentum a good fit for the large and mid cap space? Isn't momentum typically associated with fast moving small caps or thematic bets?
Yeah, I think that's a very good question because people think that momentum is all about small caps, micro caps, etc. But you will be surprised. Large and mid caps, if the stocks are in momentum, they catch a sustained momentum phase or a period, and the returns are far better superior than compared to the steady state other large cap stocks, or for that matter, even the small cap stocks. For example, Bharti Teles of the world, Indigo, DB's Lab. So all these are large cap names, and they have entered into a sustained momentum phase, and a lot of wealth gets created. And the alpha that large and mid cap generates when the stocks are in momentum, from a risk adjusted perspective, they are far superior than the small cap. See, the problem with small cap is what? Because the participation of the institutional investors are less, it is a well diversified, or public participation is more. Therefore, in small caps, when stocks go up, they also have a large volatility, and it is possible that a stock may not enter into that momentum phase. And sometimes momentum factor, when we run, we may get caught on the wrong side. Not that every time, but sometimes the probability of catching a wrong stock in momentum is slightly higher in a small cap compared to a large and mid, because of steady state performance. So I think large and mid cap space, one if one wants to get into momentum as a factor for investing, I think is by far one of the best. The large and mid cap space in last 20 years have delivered 19x return. If we understand the proxy to that, the proxy to that is our 200 momentum 30 index that has delivered 36x return in last 20 years, right? So momentum as a factor has generated far superior return even in the large and mid cap space.
Okay. You have introduced the care momentum strategy. Could you break down that for investors in simple terms?
Care momentum strategy has four filtering factors. Care stands for cross-sectional momentum. Basically, when we identify a stock in momentum out of a bunch of sector, or a bunch of stocks, so the stock that is doing better than the rest is the stock that gets identified through cross-sectional. Then comes absolute momentum. This looks at stocks' absolute return performance, a stock making 52-week high, a stock making a 2-year, 3-year high. So this is how we identify absolute momentum stocks. Then comes on the fundamental side. So the cross-sectional and absolute are on the price side. Secondary market data gets consumed to identify those two type of momentum factor. Then the other is the revenue and earnings. There is a fundamental. These are the fundamental filters that allow us to identify that stocks should also have revenue growth and earnings growth. So these are basically four factors that allow us to filter stocks, which eventually enter our momentum portfolio in the large and mid cap space.
Okay. So, With a momentum-based strategy, how frequently do you reshuffle the portfolio, and how do you manage the trade-off between responsiveness and cost?
Yeah, I think that's a great question because people think that momentum is all about buying, selling, etc. See, momentum is true. Momentum is all about buying and selling. But what kind of stocks we are buying and selling? For matter, a steady state stock which is not in momentum will have a yearly high and low of say 15 to 20-25%. So this is what the range of that particular non-momentum stock. For a momentum stock, that range may vary from 50 to 70%. So this is how this stock is in momentum. So now we will let go 12% from the bottom, and we will know that, oh, this stock is running faster than the rest of the pack. So we have identified the stock once the price is up by 10-12%. So now when prices have reached by say 45-50%, and if the stock starts to turn, so we will also let go 5-10% from the top, and then only the system will identify that, oh my god, this now stock is getting out of momentum. So we have left 10 and 10 from the top and bottom. So the balance 30%, the middle portion is what the momentum strategy tries to capture. And given the cost of buying and selling, it's nominal. Transaction costs have come down to such low levels that it is worth it to even buy and sell. And sometimes we may not get the right stock. It is also worth it to get out from that stock and even incur that small churn cost. So eventually, momentum is all about getting the middle portion of that trend. And so at times, there are so many stocks who do far well, and we are trying to capture the middle portion, and we will give away the tops and the bottoms out of it in spite of incurring certain additional transaction and brokerage costs.
Okay. So, momentum can work brilliantly in bull markets, but sometimes backfires in choppy conditions. So, how do you manage the downside risk in this fund?
So currently 31 funds are there. Everyone has a style, value, growth, quality, and none of them has the word momentum in their investment strategy. See, when markets are in bull phase, momentum will do far well because momentum factor has in long term generates far superior alpha. But the problem in momentum is what? When markets are sideways, in this phase or this phase, momentum will underperform. Why momentum underperforms? Because by very definition, momentum is all about buying, selling. It is all about hedging and unhedging. When markets are sideways, we are incurring a cost, right? That cost is in the form of transaction cost, the brokerage cost, and at times impact cost. So this is where, compared to the other strategies, which is either quality, value, growth, they are not doing buying and selling. So they are not incurring those costs, those impact costs. And relatively, when people look at a discrete period of this sideways or corrective market, our fund looks like we have underperformed because we have already incurred a cost and there is an impact cost in our NAV. But that is a cost for the momentum as a strategy, just like an insurance cost to take care of the risk. Because as momentum, we also have to hedge when markets are falling. So when markets are down, when markets are falling over here, we will hedge. And again, if market starts to rise, we will unhedge. But that's fine. Someday, when market enters into this typical bear market phase, momentum as a strategy wherein we manage funds dynamically, right? Because momentum is all about buying, selling. It is all about hedging, unhedging. So by this time, when markets are falling, as momentum strategy, we would have already hedged, and that is how we will have downside protection. But in these phases, sideways market, momentum will always underperform. Whoever works on the momentum as a factor, sideways market is where momentum will underperform, and at times momentum stocks fall more than the general market trend, and that is why momentum has certain phases. But by far, it covers up everything when the acceleration phase begins or when the momentum phase begins, because those stocks run faster than the rest of the market, and this is how it covers up the underlagging or the underperformance.
What type of investor is this fund best suited for? Should it be a core holding or a tactical alpha seeking part of a portfolio?
See, actually, every investor needs to have one or two fund, high impact fund, right? So in a team of 11 players, there are one or two players who are strike players, right? Who have a high strike rate, and if they play, they create a match-winning score. So this is how momentum is all about, that high strike player. If there is bull market, momentum will do far, far better than the rest of the other investing factors, quality, value, growth. And therefore, one needs to have one or two player, keeping in mind that at times, if market don't perform, right, market can enter into a sideways or corrective pattern. That's the time momentum fund will sit out of the class, and probably momentum fund will be the only fund who will be sitting at the bottom of the pyramid. And that is why we say that one needs to understand that momentum as a factor does far beautifully well in bull market, and in sideways correcting market, momentum will relatively underperform vis-a-vis everyone else. And if bear market comes in, our momentum fund will do better because there is an hedging provision. So this is why every investor needs to begin with one or two player with a momentum style, with the expectation that it will perform well. It is like Vaibhav Suryavanshi. It will score very well during, if the pitch is favorable, or in stock market terms, if there is bull market, momentum fund will do far well. But in other times, sideways correction market, probably that will it will get out at sit on the fences. So this is how everyone needs to begin a little bit of momentum in their portfolio, so that it will increase the overall score of their return score of their portfolio.
Well, that brings us to the very last question of this segment. From an asset allocation point of view, how should investors combine this fund with others, say a flexi cap or a large cap fund?
I think this is very important so that investors can have a proper mix or diversification of portfolio. If you see the upper line, the dark blue line, uh, in the last 6 7 months, the large and mid cap index has corrected by 6.5%. But the momentum factor, the momentum 230 stock has corrected by 18%, 18%. Therefore, momentum factor has done on the other side, which has underperformed massively. But momentum will come back because markets are mean reverting, and certain factors may not perform in certain phase. But again, when bull market comes, momentum factor does perform. So when given that such a huge underperformance of momentum as a factor has been in last 6 7 8 months, that's the time investor needs to have momentum as a factor in their overall portfolio. And now let's come to the timing aspect. Next slide absolutely shows that currently the time for momentum as a factor to perform has come. So this is a ratio of momentum to the large cap. So this was a phase when momentum did far well, and then this was the phase last 7 8 months. Momentum was on sitting on the other side, and momentum was underperforming. But now, hopefully, assuming if this is what long-term trajectory of mean reverting phenomena of momentum is, then we can say that most likely the time for momentum has come, and that is why investors can allocate momentum as a factor in their portfolio, and probably even large and mid cap space is a great time to invest for that, so that the long-term wealth creation becomes far superior.
Well, thank you so much, sir, for sharing all the valuable insights.
Thank you.
Well, that was Umesh Kumar Mehta on Samco's new large and mid cap fund and their unique momentum strategy. Stay tuned for more expert interviews to help you invest smarter.